Welcome to the deep dive. This week, we're doing something a bit different. We're bypassing the headlines and going straight into the deep data.
That's right. A listener sent us this incredibly detailed report. It's the AI IntelliTraders team's weekly performance analysis for gold ETFs, covering everything up to the market close on October 31st, 2025.
Yeah, and this isn't just, price updates. We're talking serious metrics, volume ratios, buyer versus seller strength, moving averages, even these overvalue flags. It covers, 14 different gold products?
14, yeah. ETFs,
Yes.
ETNs, even the futures contract. So our mission today really is to break down these numbers, see what the AI is flagging, compare the big players, and figure out what the technical picture for gold actually looks like right now.
Exactly. Sort of like code breaking the market's technical signals. Before we jump into specific ETFs, though, we need to get a handle on the language. This overvalue thing pops up a lot. What exactly does, say, 20% overvalue mean, according to this AI?
Okay, good question. Crucial point, actually. When the report says 20% overvalue, it means the current price is trading 20% higher than the AI's calculated true value for that day.
And how does it calculate that true value? Is it like a fundamental value?
Not fundamental in the traditional sense. It's based on their proprietary model, looking at things like recent price action, volatility, liquidity, mean reversion tendencies. Essentially, it's a technical equilibrium level.
So 20% above that equilibrium is bad.
It's a warning sign, yeah. The report flags it as unusual activity. It suggests the price is stretched, like an elastic band, and might be due for a pullback, maybe a sharp one, to get back closer to that calculated value.
Got it. And the other terms, we see things like Ivy rank 23% N-word and power dynamics like 3 seller UP, buyer down.
Right. So IV rank, implied volatility rank, it basically tells you how the current implied volatility, the market's expectation of future price swings, compares to its own history over the last year. So D-N-word, like 23% D-N-word, means volatility expectations are actually cooling off relative to the past year. Which would be interesting. It might mean things are settling down, or maybe it's the quiet before a bigger move.
And the seller UP, buyer down.
That's about the immediate pressure. Seller UP, buyer down means selling intensity is increasing while buying interest is fading at the same time. The number, like the 3, just gives a sense of the intensity of that pressure. So 3 seller UP, buyer down is a pretty clear signal of short-term technical weakness. Sellers are pushing, buyers are stepping back.
Okay, definitions locked in. Let's dive into the big ones, the physical gold ETFs everyone knows. All right, starting with the absolute titan, GLD, the SPDR Gold Shares ETF, closed at $368.12. And the volume, wow, over 11 million shares daily. This is the benchmark, right?
Absolutely. If you want to know what the market is doing in gold ETFs, you look at GLD first. And right away, its profile shows this key tension we're seeing this week. Well, you've got that 23% downward high V rank we just discussed, volatility cooling off. But at the same time, it's flagged at 20% overvalue on the daily time frame. That's a significant premium.
20% overvalue on the biggest gold ETF. That feels like a major warning. If sentiment shifts, that premium could evaporate fast.
It certainly could.
Yeah.
And the moving averages really paint the picture here. The report confirms GLD is above the 200 days moving average. That's the big long-term structural support. It's holding.
Okay, so the long-term uptrend is technically still intact.
Yes, fundamentally, the long view looks solid based on that MA. However, it's also below the 200 hours moving average.
Ah, the short-term picture. So strong foundation, but the immediate trend is down.
Exactly. Think of the 200-hour MA as the current tactical direction. Being below it means the price has rolled over recently. It's correcting within that larger uptrend. Healthy in the long run, maybe, but definitely points to short-term weakness.
And does the power signal match that?
It does. 3 seller UP, buyer down. That 3 indicates pretty strong selling pressure, dominating the recent action, pushing it below that 200-hour level, while buyers are clearly less enthusiastic.
Okay, so high price, 20% premium, correcting short-term, selling pressure, winning. What about participation? Is everyone rushing for the exits?
Well, that's the other interesting piece. You'd expect maybe panic selling, right? But no, GLD's daily volume was actually only 74% of the previous day's volume.
Oh, lower volume.
Yeah, and the weekly volume was even lower, just 59% of the week before. So volume is actually drying up quite significantly.
So the price is high, correcting, but fewer people are trading it compared to before. What does that usually imply?
It often suggests a lack of conviction behind the current price level. The price is sort of hanging up there, but the energy, the participation is fading. That can make it vulnerable to a sharper move if, significant new volume comes in suddenly. Either way.
Okay, let's look at the next biggest one. IAU, the iShares Gold ETF, priced around $75.39. Similar story.
Pretty much a technical twin to GLD, yeah. Slightly less volume, about 9.5 million shares, but it mirrors GLD almost perfectly on the key metrics.
So same 20% over value.
Yep, same 20% overvalue flag, same 23% downward 5V rank, and the same split with the moving averages. Above the 200-day, below the 200-hour, the technical picture is consistent for these giants.
Any difference in the volume ratios for IAU?
Minor one. Daily volume ratio was a bit healthier at 91% of the previous day, and weekly was 64%. Still showing that cooling trend, less participation than before, but maybe slightly less dramatic than GLD's drop-off.
All right. And the third main physical fund, GLDM, the SPDR Gold Mini-Shares ETF, $79.19. This one often attracts more retail interest, right?
It does, yeah. And it largely follows the pattern. Still got that 20% overvalue warning. Still above the 200-day MA, below the 200-hour MA. The main structure is the same.
But there's a difference. I see the IV rank is NA here.
Right. IV rank isn't calculated for it in this report, but the key difference is actually in the daily volume ratio.
Oh, what did GLDM do?
Unlike GLD and IAU, where daily volume cooled off, GLDM's daily volume for Friday was 103% of the previous day.
So slightly more volume than the day before. An outlier.
Exactly. It suggests that on that specific closing day, maybe retail or smaller players using GLDM saw the dip as a buying chance, or there was some other concentrated activity there which wasn't happening in the bigger funds.
It's interesting, though the weekly volume ratio is still down.
Still down, yeah, at 76%.
Yeah.
So the weekly trend is still cooler, but that little daily pop in volume for GLDM is definitely something to note.
Okay, let's quickly cover one more physical ETF before we get into the leveraged stuff. SGO, the ABRDN physical gold shares. $38.13, decent volume around 5 million.
Yeah, SGO basically just reinforces the main theme we've seen. It's got a similar IV rank, 22% downward. It's got the same 20% overvalue flag.
Same moving average split, too. Above 200D, below 200H.
Correct. Above 200-day, below 200-hour. Its daily volume ratio was exactly 100%, so activity matched the previous day perfectly. No big surge or drop there.
Yeah, and I see a note here. Daily true value squiz is 2. What's that telling us?
The squiz metric. In this AI system, squiz measures how tight the recent trading range is compared to its underlying true value calculation. A low number, like 2 here, basically confirms low immediate volatility or compressed range.
So even though it's 20% overvalue long-term, the very short-term price action was kind of quiet, squeezed.
Exactly. It fits with the cooling IV rank picture. It suggests maybe the market was pausing, consolidating in a tight range, perhaps before the next bigger move happened.
Okay, that makes sense. Now let's shift gears dramatically. Leveraged products. First up, UGL, the ProShares Ultra Gold ETF.
Yeah.
This aims for double the daily return of gold, right?
That's the goal, yeah. Double long. And this is where things get, well, significantly more volatile and stretched. UGL closed at $48.68.
How does its IV rank compare?
Jumps way up, or rather the downward pressure is on a higher base. It's 47% N-ward. Still cooling relative to its own history, but its baseline volatility is clearly much higher than the physical ETFs that's typical for leverage.
And the valuation. If GLD was 20% overvalue.
UGL blows past that. It's flagged at 34% overvalue on the daily time frame.
34%. That's a huge premium. Holding a double long ETF at that kind of valuation sounds incredibly risky.
It is. Extremely risky. And look at the critical support level. Remember how GLD was clearly above the 200-day MA?
Yeah.
The AI note for UGL is different. It says put 0.4 200 days moving average.
Put 0.4. What does that mean?
In this AI's notation, put means below, and the 0.4 likely refers to standard deviation units or a similar measure. So it's saying UGL actually closed below its 200-day moving average. Maybe not by a huge amount, but it failed to hold that key long-term support.
Wow. So the leverage didn't just amplify the gain potential, it amplified the pullback so much it actually broke that long-term structure that the physical funds held on to.
Precisely. That leverage makes it much more vulnerable. The short-term weakness was enough to crack its long-term foundation, which is a major technical warning for UGL specifically.
Okay, now let's look at the other side of the coin. GLL, the ProShares Ultra Short Gold. Double the inverse move. If gold is weak short-term, this should be doing well technically.
And it is. GLL, priced around $15.18, shows the expected technical alignment for a successful short. The report confirms it's below the 200 days moving average and also below the 200 hours moving average.
So the underlying trend, gold, is weak on both long-term, for GLL's perspective, and short-term time frames, according to this inverse ETS position relative to the MAs for gold itself.
Well, technically, GLL being below those MAs means gold itself is showing strength relative to those MAs, pushing the inverse product down. Wait, let me rephrase that. For GLL to be doing well, gold needs to be weak. The report actually states GLL is below both MAs. Let me double check that. I misread the outline summary context. The outline says GLL is below 200D and 200 HMA, which would mean GLL itself is weak, implying gold is strong. Let's assume the original AI report data for GLL would logically show it above ED its own relevant MAs if gold was weak. Let me reread the outline point for GLL.
The outline says below 200 days moving average and below 200 hours moving average. That does sound like GLL itself is weak.
You're right. Okay, sticking to the provided data. GLL is below both MAs. That's counterintuitive if gold is weak short-term, as suggested by GLD being below the 200 HMA. Maybe GLL's own trend calculation differs, or there's a lag, or the outline summary simplified it. Let's proceed with what's written. GLL is technically weak itself, below both its 200D and 200 HMAs.
Okay, so GLL is technically weak, but what about volume? Is everyone piling into the short side?
Actually, the opposite again. GLL's weekly volume ratio is really low, just 42% of the week before. It's the lowest weekly participation we've seen among the main products.
That's bizarre. If gold is showing short-term weakness, like GLD below 200 HMA suggests, why would volume disappear from the main short ETF, which is also technically weak itself?
It's a conflict, isn't it? Low volume on the short side, and the short ETF itself is weak. Maybe the conviction isn't there for the bears. Or perhaps most shorting is happening elsewhere. It definitely suggests a lack of strong bearish follow-through in this particular product.
But what about the power dynamic for GLL? Who is actually trading it?
Now this flips the script again. The daily weekly buyer-seller direction for GLL is buyer UP, seller down. And it's marked as M trend, or moderated trend.
Buyers are UP on the short ETF, even though it's technically weak and volume is low.
Yes. Buyers are gaining control, sellers are retreating, according to the power metric for GLL. This is the structural opposite of what we saw in GLD. So even with low volume and weak MA position, the flow within GLL trading shows accumulation by buyers, those betting against gold via GLL. It's complex. Maybe short covering looks like buying here, or new shorts establishing positions. The M trend suggests the shift is significant, but not yet extreme.
Okay, that's a lot to unpack. We have the physicals mostly aligned, 20% overvalue, above 200D, below 200H, cooling volume. The leveraged long UGL, very stretched, 34% overvalue, below 200D. And the leveraged short GLL, showing weak MAs, low volume, but rising buyer power. Let's quickly touch on a few other physical contenders, AAAU and OUNZ.
Right, AAU, $39.48, and a UNZ, $38.52. They mostly stick to the script, 20% overvalue, that same split moving average picture. But they have one really key difference from GLD and IAU.
What's that?
Their 5E rank. Remember, GLD-IU had 5E rank going D-N-ward.
Yeah, cooling off.
Well, AAU and OUNZ both show their IV rank as upward, 22% and 23% upward, respectively.
Volatility expectations are increasing in these specific funds. Why would they differ from the big guys?
It's a great question. It suggests that maybe the options traders or more active speculators using these particular ETFs are pricing in more uncertainty. Anticipating a bigger move soon could be a sharp drop or maybe a surprising spike. While the broader market GLD-IU seems calmer, there's nervousness bubbling up in these specific spots.
Interesting. And rounding out the physicals, BAR, the Granite Shares Gold ETF.
Very low volume, under a million shares, $39.40 price. NA for 5E rank, but it still carries that standard 20% overvalue flag. It just confirms that premium is pretty much across the board for physical gold vehicles right now.
Okay, now for something potentially very different. The gold futures contract GCZ25, priced way up at $4,008. How does the institutional money, the futures market, look technically?
This is probably the most important divergence in the whole report. Unlike the ETFs struggling below their 200-hour MA, the GC futures contract is confirmed, above both the 200 days moving average and the 200 hours moving average.
Above both, so strong long-term and strong short-term momentum.
Exactly. The futures market is showing sustained strength, holding its short-term trend upwards, which is the complete opposite of the picture we got from GLD and IAU. It suggests, the really big players, the commercial hedgers, the big specs in the futures pits, they are maintaining bullish conviction.
And does the valuation reflect that conviction?
Oh, absolutely. Get this. The futures contract is running at 51% overvalue based on the daily time frame.
51%. More than double the premium on the physical ETFs. Wow.
It's the highest premium we've seen so far among the, let's call them, mainstream products.
Yeah.
It tells you that the participants driving the futures market are willing to pay a massive premium compared to the AI's calculated value. Could be hedging needs, macro bets, whatever, but the price is extremely stretched there.
What about the power dynamics in futures? Still seller UP like the ETFs?
Nope. Opposite again, the daily weekly direction is seller down, buyer UP. Marked as a strong end trend, meaning neutral to bullish trend power. Buyers are firmly in control, sellers are backing off. The futures market is sending a clear bullish signal, technically speaking.
So we have this major split. Physical ETFs are correcting short-term underselling pressure, while the futures market is strong, super premium with buyers in charge. How do we square that?
That's the million-dollar question, isn't it? Is the futures strength keeping the ETFs from falling further? Or are the futures dangerously disconnected and setting up for a fall that could drag everything else down? That 51% overvalue is a serious risk indicator if momentum shifts there.
Definitely a key tension to watch. Okay, this seems like a good point to pause for a moment.
Yeah, absolutely.
We're digging really deep into these AI metrics today, looking at everything from moving averages to these overvalue percentages and buyer-seller flows.
And hopefully you're seeing how these specific numbers give a much clearer picture than just looking at the price chart. The MA positions, the overvalue levels, they highlight specific risks and strengths.
So if you are enjoying these insights and finding this detailed breakdown helpful, make sure to hit that follow button and maybe turn on notifications so you don't miss our market analysis updates each week.
Okay, we've covered the physicals, the leveraged ETFs, and the futures. Now brace yourself, because we're heading into the world of ETNs, and one of them is, well, it's something else.
Right, exchange-traded notes. These are different beasts, debt instruments, not shares of physical gold, often riskier, sometimes weirder behavior. And you mentioned one is an extreme outlier.
Understatement of the week. Let's talk about DZZ, the DB Gold Double Short ETN, priced at just $5.92.
Double short, so it should go up when gold goes down, right?
Theoretically, yes. But look at this data. First off, it's the only product in the entire report listed with a gap down open.
A gap down. For a short product, that implies gold must have gapped up hard at the open, crushing DZZ.
That would be the logical assumption, but then things get truly wild. Look at the volume. The weekly volume ratio for DZZ is 444% of the week before.
444%. That's not a spike, that's an explosion. What on earth happened there?
It indicates a massive, sustained event involving this ETN over the past week. Huge amounts changing hands. But here's the kicker, the valuation number. DZZ's price is reported as 287% overvalue.
287%. Overvalue. For a double short ETN, that just sounds broken. How is that even possible, especially after a gap down?
It almost defies rational technical analysis. A short product trading at nearly 3 times its calculated true value suggests something extreme happened. The most likely explanation, a massive, potentially catastrophic short squeeze.
So people who were short gold, via other means maybe, got squeezed, and in panic, they had to buy back this DZZ short ETN at any price, driving its value completely detached from reality.
That's the narrative that fits these numbers best. The gap down might have been the initial pain, followed by a relentless scramble to cover, pushing the ETN price to absurd levels despite its theoretical purpose. The 444% volume confirms huge turnover during this event.
Does the rest of the technical picture support that squeeze idea?
It does, bizarrely. Despite being a short ETN, its technical posture is bullish. It's above the 200 days MA and above the 200 hours MA.
So the ETN itself is in an uptrend, technically?
Yes, and the power signal. Buyer UP
Yeah.
on both daily and monthly. Maximum buying pressure. Total buyer control of a double short ETN. It's the hallmark of a squeeze.
Wow, okay, that DZZ situation is definitely the anomaly of the week. It suggests extreme stress somewhere in the leveraged short side of the gold market.
Absolutely. It's a signal of intense volatility and possibly forced position covering that isn't visible just looking at GLD.
All right, let's look at the other ETNs. Are they more normal? How about DBP, the precious metals ETN? Tracks a basket, right?
Yeah, DBP is much more conventional, $91.90 price, technically strong, above both the 200-day and 200-hour MAs. It does have a premium, but more reasonable, 19% overvalue.
And its power signal.
Back to the baseline we saw in GLD, seller UP, buyer down. So the general short-term selling pressure seems to be hitting the diversified basket too. This helps confirm the DZZ action was specific and not market-wide for ETNs.
Okay, Then there's DGP, the DB Gold Double Long ETN, $141.07. What's its premium?
It lines up perfectly with UGL, the other double long product. DGP is 36% overvalue.
So that 34-36% premium seems standard for the double long exposure right now. High, but consistent between the ETF and ETN.
Exactly. And interestingly, its weekly power dynamic is noted as load in UP, M trend.
Loading up, so accumulation.
Yeah, suggests buyers were actively accumulating DGP over the week, showing that underlying bullish conviction in leveraged longs, similar to the futures market, despite the weak daily price action we saw in the physicals.
Okay, one more. DGZ, the DB Gold Short ETN. This isn't leveraged, just a straight short.
Right. And this one is notable mainly for how little activity there is. Extremely low volume, just 1,573 shares. Today's volume was only 13% of the day before. It's almost inactive.
And the technicals on such low volume.
Can be unreliable, but the note says cross 200 days moving average, meaning it's sitting right on that key long-term line. It's at a pivot point, basically, with no volume conviction to push it clearly one way or the other.
Valuation.
The lowest premium we've seen, only 11% overvalue. Okay. And power shows seller down on both daily and weekly, so lack of interest, sitting on the fence technically.
Okay. We've journeyed through the physicals, the leverage, the futures, and the weird world of ETNs. Let's try to bring it all together. What are the main technical takeaways from this AI report for the week ending October 31st? Let's start with the moving averages.
The big picture from the MAs is remarkably consistent for the core market. The vast majority of the physical, non-leveraged funds like GLD, IAU, SGLL, etc. are in that split state, above the 200-day MA, but below the 200-hour MA.
So to translate that for someone holding gold or thinking about it, what's the practical message?
It means the long-term bull structure seems intact. That 200-day support is holding, which is crucial. But you absolutely need to respect a short-term weakness. Being below the 200-hour MA combined with the power signals we saw indicates we're clearly in a correction. More downside or sideways chop is likely until the price can get back above that 200-hour level with some conviction.
And we need to remember the exceptions, right? The futures contract GC and weirdly DZZ were above both MAs, showing strength, and the leveraged short GLL was below both, indicating its own weakness.
Exactly. The passive money might be pulling back, but the futures market and the distressed parts, like DZZ, are telling a different story. That divergence is key.
Okay, takeaway number 2, the overvalue trend. It was everywhere.
Pervasive, yeah. We saw a clear hierarchy develop. The baseline cost of admission for physical gold ETFs, GLD, IAU, is running at 20% overvalue.
Then, stepping up the risk ladder, the leveraged longs, UGL, DGP, commanded a much higher premium, 34% to 36% overvalue.
Right. And then the institutional futures market, GCZ 25, topped the standard products at a whopping 51% overvalue. Shows where the most aggressive positioning is.
And then completely off the scale, the DZZ anomaly at 287% overvalue, which signals market stress more than just valuation.
That hierarchy tells you a lot. The price seems increasingly driven by speculation and hedging demand, futures, leverage, rather than just core physical accumulation, pushing premiums higher the further out on the risk curve you go.
Okay, third major takeaway, the buyer-seller power dynamics and volume.
The dominant signal across most ETFs, especially the big physical ones, was seller UP, buyer down. Clear corrective pressure.
But the buyers were showing up strong in specific places.
Yes, crucially, in the futures market, seller down, buyer UP, and paradoxically, in the inverse products, GLL buyer UP, DZZZ buyer UP.
So buying strength in the most capitalized market and in the shorts, what does that combination suggest?
It leans towards the idea that the buying is maybe defensive or leveraged, rather than broad-based bullishness. Like strong futures buying could be hedging, and the buying in inverse products points towards short covering or bears initiating positions. It doesn't feel like confident new money flooding into physical gold.
And the volume confirms that lack of new confidence.
I think so. Seeing weekly volume drop to 59% for GLD and 64% for IAU, despite prices staying elevated, really underscores that. Participation is thinning out, which often happens before a more significant move. High prices on low volume is generally a caution sign. Hashtag, outro. So wrapping it all up, this AI report paints a picture of gold with a solid long-term foundation holding above that 200-day MA is key. But it's facing significant short-term headwinds. It's broadly overvalued, starting at a 20% premium for basic physical exposure and seeing clear selling pressure dominate the ETF space, all while overall market participation cools off.
But the story isn't just simple consolidation. The real headline grabber this week has to be that DZZ situation, a double short ETN trading 287% over value on 444% weekly volume after a dap down. That screams stress.
It absolutely does. It suggests a potentially violent short squeeze occurred, indicating extreme distress for some players betting against gold. That kind of force buying in an inverse product, even if anomalous, can sometimes have knock-on effects, maybe temporarily supporting the underlying gold price before the fundamental overvaluation eventually matters again.
And that leads us to the final provocative thought, doesn't it? We have this underlying weakness and overvaluation in the main ETF market. But it seems to be countered, or at least complicated, by intense strength in the futures market and sheer panic or pressure in parts of the leveraged short market, like DZZ. What happens when that tension finally snaps? Which force wins out?
That's the question for the week ahead. Does the futures strength pull the ETFs back up, or does the ETF weakness and extreme overvaluation eventually pull everything down? The DZZ data suggests the volatility might not be over yet.
Definitely something to keep a close eye on.
And listen, if these deep dives into the AI metrics and the technical signals are helping you make sense of the markets,
Yeah, if this helped you navigate the data, definitely hit that follow button, turn on the notification. We do this analysis every week, trying to give you that edge.
we'll be back next week to see how this picture evolves.
Until then, thanks for joining us on The Deep Dive.